Welcome to The Deep Dive, the show where we cut through all the noise and pull out the key insights for you.
That's right.
Today, we're diving into the latest earnings call from Tyson Foods. It happened Monday, August 4th, bright and early, 9 a.m. Eastern.
Yep. Got the coffee ready for that one.
We've sifted through the transcripts, the reports, everything, to really understand what's going on with Tyson.
Mm-hmm.
Our mission today, figure out what these numbers actually mean for Tyson's strategy and where they're headed, especially with some, tricky market conditions out there.
Absolutely. And, starting with the headline numbers, Tyson didn't just meet expectations. They really smashed them this quarter.
Oh, really?
Yeah, it feels like a sign. Their big strategic focus is really paying off. Adjusted EPS, that's earnings per share, it jumped to $1.91.
Okay, and what were analysts expecting?
They were looking for about 0 to 78 cents. So, a pretty significant beat. And revenue did the same thing, came in at $13.88 billion. But the street was thinking more like $13.56 billion. That's a solid 4% jump year over year.
Right.
But here's the kicker, I think. This is the fifth quarter in a row they've grown sales, adjusted operating income, and adjusted EPS compared to the year before.
5 straight quarters in this market.
Exactly. That kind of consistency, especially with commodity markets being so, up and down, it really suggests they're finding ways to make their business more stable, maybe less risky.
Through that strategic pivot we hear about.
I think so. Finding profit even when things are tough. Now, the official GAAP EPS was lower, 17 cents, because of accounting rules and adjustments.
Sure.
But the market really focuses on those adjusted numbers for the operational health,
Got it. And how did investors react initially?
Pretty positively, yeah. The sentiment seemed favorable right away.
Okay, that makes sense. A strong performance, especially that fifth quarter streak. So let's dig deeper than just the top line numbers. What was management actually saying on the call about why this is happening? What's the strategy?
Well, management was super direct. The CEO, Donnie King, he basically said, and I'm quoting here, sales, adjusted operating income, and EPS all grew. Our strategy is working.
Can't get much clearer than that.
Right. And it's not luck. It's this deliberate shift they've been making. They're really pushing towards those higher margin products like branded chicken and prepared foods. That's where the better profits are.
Instead of just basic commodities.
Exactly. And they're also hammering on efficiency, operational excellence initiatives, they call it. Things like optimizing their network, which meant closing some chicken plants that weren't running full.
Tough decisions.
Yeah, and even slowing down the beef processing lines because, frankly, the cattle aren't there right now. That's a big deal for beef.
And what about the consumer? What did they say there?
The message was, people are still careful with money. No surprise there. But protein is still something they prioritize buying.
Okay.
And that plays right into Tyson's hands with their mix of chicken, pork, beef, prepared foods. They actually gained market share, both in volume and dollars, in their top 10 categories. Think Tyson Chicken, Hillshire Farm, Jimmy Dean, those big names.
Okay, so that strategy, higher margins, efficiency, leveraging the consumer's focus on protein seems critical.
Mm-hmm.
But it sounds like Tyson's story isn't uniform across the board, right? Performance varies a lot by segment.
Oh, absolutely. It's definitely a tale of different markets within one company right now.
So where should we start? Maybe with prepared foods. Sounds like that was a highlight.
Yeah, let's kick off there. Prepared Foods genuinely had its best Q3 ever. Their words.
Wow.
Adjusted operating income, that's AOI. Segment profit basically shot up 21%, and margins expanded by 150 basis points.
Which is 1.5%, right?
Correct. 1.5% wider margins. And what's really impressive is they got back to growing revenue, even though they got hit with about $60 million in unexpected raw material cost increases.
Whoa, how'd they manage that?
Just really strong execution, being efficient. It says a lot. And innovation's huge here.
Yeah.
Things like new Hillshire snacking dips, those new handhelds, they're catching on, driving sales and share.
That's a great story for prepared foods. What about chicken? That's been a big focus area for investment.
Chicken's still on a roll. Third straight quarter of year-over-year volume growth. But here's the important part. It's the kind of growth.
Meaning?
Value-added chicken, the pre-cooked marinated stuff, higher margin items, that volume grew 3.5 times faster than just plain chicken volume.
So a much richer mix.
Exactly. Better mix boosts the bottom line. Chicken AOI was up 12%, and that profit growth came mostly from finding more efficiencies in their plants, especially since grain costs have been pretty stable lately.
Any specific products doing well?
Yeah, they mentioned the relaunch of Tyson-branded frozen value-added chicken saw a 10% volume bump, and new things like simple ingredient nuggets are hitting the mark, too.
And they think there's more room to run in chicken.
Management was clear. They don't think chicken has peaked, and they're putting their money where their mouth is, finishing up a big, roughly $400 million investment in Q4.
Wow.
And that's not just upkeep. It's aimed at driving more efficiency and innovation. They're committed long-term here.
Sounds like a lot of momentum in chicken.
Yeah.
Okay, shifting gears, how did pork do?
Pork actually had its strongest Q3 adjusted operating income in 4 years.
Really? How?
Mostly from optimizing their plants and pushing more value-added products, better labor use, better asset use. It all helped profits.
And the outlook for pork supply?
Interesting dynamics there. The USDA sees production up slightly, maybe 0.9% in 2025, 1.6% in 2026.
Okay.
But Tyson noted that the high cost of building new barns might actually slow down how fast producers expand. So supply might end up tighter than those numbers suggest down the road. Could impact prices.
Interesting. Okay, so prepared foods, chicken strong, pork improving. But Donnie King mentioned an only soft spot. I'm guessing that's beef.
You guessed it. Beef was the only soft spot, and yeah, it's pretty significant. The AOI loss actually widened, now expected between $375 and $475 million for the year.
Ouch. Why so tough?
It boils down to much tighter cattle supply, which really squeezes their margins, their spreads. I mean, beef cow slaughter is down 16% just this year so far. It's dramatic.
And when does that get better?
That's the million-dollar question, or maybe billion-dollar question. Herd rebuilding isn't expected to really start in earnest, as they put it, until 2026.
2026. So benefits are still years away.
Probably. Real benefits hitting the bottom line might not show up until maybe 2028. It's a long haul.
So what can they do in beef right now?
Focus on controlling the controllables is their mantra. Using data analytics to get the most value out of each carcass, making sure they fill orders. They hit 98% fill rates, which is good. And they've cut over $100 million in controllable costs just this year. They're managing what they can.
Okay, that makes sense. It's a tough cycle. And quickly, how about international?
International was strong, again, driven by those operational excellence efforts globally. Better efficiency, lower costs to convert raw materials, just tight cost management. And they expect that momentum to carry into fiscal 26, shows the value of their global reach.
So after running through all the segments, that contrast between beef and the others is stark. Let's zoom back out. How does the company look financially overall? Balance sheet, cash flow, that sort of thing.
Yeah, the financial picture has really improved. They've worked hard on the balance sheet. Net leverage is down to 2.1 times.
Which is way down from that peak, wasn't it? Like 4.1 times.
Exactly, it's 4.1 times. So 2.1 is a massive improvement, much less risk on the books. They've got plenty of liquidity, too, about $4 billion.
And cash flow.
Really strong. Year-to-date free cash flow, the cash left after running the business and investing, was $929 million. That easily covers their dividends, which are $524 million. And here's a big signal of confidence. They restarted buying back their own shares on the open market, spent $21 million in Q3. That's the first time since early 2023.
Ah, okay. What does that signal?
It signals management feels really good about their cash generation and that they have room on the balance sheet. Dividends are still the main priority for returning cash, but they clearly see buybacks as a good use of funds right now, too.
And what about spending on big projects, capital expenditures?
Still disciplined there. CapEx is expected to be at or below $1 billion for the year. And they actually raised their free cash flow guidance for fiscal 25 to between $1.0 and $1.3 billion.
Raised guidance, that's positive.
Yeah, though they noted the range narrowed a bit, partly because working capital needs are higher with sales growth and, well, those higher cattle costs we talked about.
Right. Okay, so that improved financial health and confidence naturally leads to the updated outlook for the rest of the fiscal year, FY25. How do they change the guidance?
They definitely raised the overall outlook, signaling optimism. Total sales guidance is now expected up 2% to 3% year over year.
Okay, that's up from flat to 1% before, right?
That's a decent bump. And total company adjusted operating income guidance also got raised and narrowed. Now, $2.1 to $2.3 billion suggests pretty significant growth ahead.
And by segment.
Chicken AOI guidance was lifted to $1.4 billion, showing that continued strength.
But beef.
But beef, yeah, the AOI loss forecast was widened to that $375 million to $475 million range, just reinforcing those tough multi-year cattle supply issues. No sugarcoating that. So if you put all that into context for an investor, you've got this weird backdrop, right? Record high beef prices, smallest cattle herd ever.
Which sounds bad for Tyson beef, but
Maybe good for Tyson overall because consumers are trading down. They're buying more chicken, more pork, and Tyson sells a lot of chicken and pork, so their mix helps buffer them.
right, the diversification pays off.
Definitely. Near-term things to watch. Feed grain prices are always volatile, labor costs, and that screw-worm risk is out there, though management sounded pretty confident the USDA is on top of it.
Okay, so navigating challenges, but also capitalizing on strengths. Looking ahead, what are the key things investors should watch for? Catalysts, inflection points.
Well, obviously the next earnings report, Q4 in November, gives the full year picture. Then, how well do those new snack lines sell over the holidays? That tests the innovation engine.
Makes sense.
And keep an eye on those USDA cattle reports for any sign of herd rebuilding accelerating or not. But the big one, potentially, is 2026. If beef margins start to look firmer then,
That could change the whole
it
story.
would be a major narrative shift for the stock, yeah. But for now, near term, the focus is can Tyson keep crushing it in chicken and prepared foods and turn that into better overall returns, ROIC, even while beef is dragging?
ROIC, return on invested capital, key metric.
Crucial one. So investors like the raised guidance. You saw the stock pop. Options looked bullish, but the stock is still down over the past year, even with that pop. So longer-term caution is still there. Analysts are split too. Stephens is positive, saying overweight because chicken's so strong. Bernstein says hold, pointing to valuation versus that tough cattle cycle. It's complicated.
Definitely a mixed picture. Which brings us perfectly to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea, like we're pitching the investment committee. What are you thinking this time?
Okay, all right, here's the pitch. Imagine this. Go long Tyson stock, ticker TSN, but pair it with a tactical short position.
Shorting what?
Either short a company that's only in beef processing, a pure play peer, or maybe short an agricultural ETF that's heavily weighted towards beef.
Okay. Why that combo?
It plays directly into the split story we've been talking about.
Yeah.
The long Tyson bet captures all that upside momentum in their high-margin chicken and prepared foods. The innovation, the efficiency gains, the share growth. The raised guidance, the buybacks restarting management's confident in those parts they control. The short leg then acts as your hedge. It protects you against that really tough, drawn-out beef cycle problem. You acknowledge the big beef loss, the long timeline.
So you isolate the good parts of Tyson.
Exactly. You benefit from their strategy and execution in the strong segments while insulating yourself somewhat from the big external headwind in beef. You're betting on Tyson's ability to outperform despite beef, not necessarily betting against beef recovering eventually. It isolates the alpha from their diversification.
That is actually a pretty clever way to play this specific situation. Isolate the alpha, hedge the cycle. I like it. Okay, to wrap this up then, Tyson Foods is clearly showing strong execution, smart strategy, leveraging that diverse portfolio, innovating, all while wrestling with a very difficult beef market.
And just to reiterate, this segment was purely for discussion, definitely not financial advice. Please do your own homework.
Always. So here's the final thought to leave you with. Given how Tyson is managing what they can control and really pushing into those higher margin areas, could this strategic shift actually lead to a permanent change in how the market values the company? Could it finally be seen as more resilient, less tied purely to the ups and downs of the beef cycle? Something to think about. We'd love to hear your take on this deep dive.